Debt Market Update October 2023. G-Sec yields rose sharply post the MPC meeting in early October 2023 as the RBI governor announced the possibility of conducting OMO sales to actively manage liquidity. Post the run-up of 10 to 15 basis points, the yield across the curve moved within a narrow range for the rest of the month, and 10-year G-Sec yields ended at 7.36%, up 14 basis points compared to last month. Apart from the aforesaid, the movement in yields was driven by factors including elevated US yields, outbreak of the Israel-Hamas conflict, rise in oil prices, strong Indian bank credit growth, etc. Corporate bond spread narrowed compared to last month on lower supply. Average interbank liquidity fell month-on-month, driven by rise in currency in circulation along with OMO and forex sales done by RBI. FPI bought, including voluntary retention route, debt worth $0.8 billion in October 2023. Cumulatively, FPIs have bought debt worth $3.6 billion in 7 months of FY24. Outlook. RBI minutes were largely in line with expectations with a balanced view on growth and inflation. Most members stated that growth momentum remains strong and inflation under control, except for occasional spikes due to volatile vegetable prices. Key risks highlighted included spillover from global capital markets, higher than target inflation of 4%, risk from food and energy prices, etc. Given the relatively hawkish RBI communication, highlighting possibility of usage of OMOs sales as an active tool for liquidity management, special emphasis on achieving its 4% inflation target on a durable basis, rising consensus on rates likely to remain higher for longer in AEs, uncertainty for Indian G-Sec market has increased in the near term. However, from a medium-term perspective, we expect the debt market to likely be driven more by favorable rather than negative factors. The key drivers which bode well for decline in yields over the medium term include robust tax collections and growth in small saving collections limits risk of fiscal slippage and additional market borrowings. Moreover, net supply of SLR securities in H2 FY24 is significantly low. Inclusion of India's sovereign securities in JP Morgan Bond Index can result in FPI flows of $23 to 25 billion, which bodes well for demand outlook for G-Sec and can effectively cap any significant rise in yields. CPI and core CPI are likely to trend lower in view of the correction in vegetable prices, decelerating core momentum, lower input price pressure, and benign global commodity prices. Inflation expectations also remain well anchored and are trending lower. Growth is likely to soften in view of decline in fiscal impulse, slowing external sector and moderation in private consumption. RBI is expected to maintain an extended pause. The bar for restart of rate hikes by RBI remains high despite sharp rate hikes by US, as adequate foreign exchange reserves should keep pressure on INR at bay. However, there are counterbalancing factors which are likely to put upward pressure on yields. Timing and quantum uncertainty with respect to OMO sales by RBI. Growth continues to remain robust, and if sustained, there is risk of core inflation reaccelerating. Headline CPI remains susceptible to elevated food price in view of temporal and spatial distribution of monsoon and its impact on crop yields. SLR holdings of the banking system is high and credit growth robust. Further, the demand from insurance sector is likely to taper down vis-a-vis last year. Hence, incremental demand from key buyers of G-Secs is likely to remain muted. Continued global monetary tightening and risk of rise in commodity prices, especially oil, driven by China reopening and geopolitical dynamics. Significant increase in global bond yields can have a rub-off effect on Indian yields as well. On an overall basis, in our view, yields are likely to trade in a range in the near term, although we believe that long end is likely to outperform over the medium term. While we continue to recommend investments into short to medium duration debt funds, given the sharp rise in yields in the past couple of months, investors could consider higher allocation to longer duration funds, in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.